about that? Oh, look at that. Quite a catch. Oh, that was a good one, Nick. Yes. Do you dare not dive for the money? Yeah. Yes. You don't want to dive for the money because, yeah. It's a euro, right? Because you don't want to look venal in front of your friends. You're not part of the 1%, right? Is it because the money's not real? Which is sort of an oxymoron. What's real money? It even reminds me of a letter I read to the Financial Times editorial staff in March of 2009. And back then, the term quantitative easing was relatively new, at least in most people's minds. And the Financial Times had authored a piece that helped to explain how central banks conjure up money out of thin air and use it to buy questionable assets. And so this gentleman, Gerald Summerlin, from Stourbridge, North Midlands, wrote a letter to the Financial Times thanking them. He said, "Thank you for helping me. I now can say that I fully understand the term quantitative easing. But I realize I no longer understand the meaning of the word money." The idea of money, still a question mark. This is, after all, what we've authored. This is a reflection of our great desires. The developed world has expanded credit really to the breaking point. How do we resolve this? We should go back a little bit at least. Okay, 100 years. To think about how we got here. I want you all to know what we see in the world tonight. I want you to understand how it informs our investment decisions. When we think this might resolve itself and how it will all look. Ultimately, we want you to have a more comfortable feeling about your money, maybe your life. That's optimistic, I know. No one can say we're perma bears at Heidel Beale. But if we think back 100 years ago, the dollar was convertible into gold. How many people think Europe can't live without the euro? In March of 2002, March 1st, the lira was sunsetted, and the Italians celebrated by throwing all their lira into the Trevi Fountain. They might want to go digging again for those. How many different monetary arrangements has the US had in the last 100 years? Anyone care to guess? 4. That's right, Odom.
I got 3.
3? Well, 100 years ago, we were on the true blue gold standard. $20.67 would buy you an ounce of gold. So the dollar derived its value from gold. After the Great War, the First World War, a different but still gold-based system emerged called the gold exchange standard. Governments could choose to use paper-backed gold certificates or transfer real gold. Guess what they chose? Paper, yeah. Then after the Second World War came Bretton Woods. No longer would each currency float against the others based on perceived gold reserves. They'd all be anchored to the dollar at a fixed exchange rate. The dollar would be anchored to gold. How about that? We can trust the Americans. So from 46 to 71, the exchange rate held still at the pre-war $35 an ounce. And then with the help of the French, Jacques Rueff, the great French economist, and Charles de Gaulle, who really threatened Nixon's administration with converting their dollars to gold and thus threatening to deplete what gold reserves we really had, forced Nixon's hand. He cut the cord. The dollar hereby would be undefined. It's not convertible into anything except small change. So now it's a derivative without an underlier. Right? Unless, of course, you think that the value of the dollar is derived from the wisdom of Congress, our able leadership, and fiscal rectitude. It'll join this litter of euros on the floor soon with that. So where are we? 100 years ago, the Fed was founded to furnish an elastic currency, to provide a means of rediscounting commercial paper, basically to be a lender of last resort in a crisis, to buy paper from banks at a discounted rate, to provide for better supervision of the U.S. banking institutions, and fourth on the charter, and for other purposes. You spot the fly in the ointment, right? And for other purposes. So we fast forward 100 years. The Federal Reserve's gone from being an entity that was supposed to operate passively through the discount window to one which is not only active but hyperactive, whose mission has come to include full employment, price stability. Might anyone just guess when prices were most stable? How about the period just prior to the Fed's inauguration? The price level, as currently measured, will probably fall. But this is due to the Fed's great success. And I'll come to this. In a way, we're victims of our success. But that success has come to an end, although it's a slow, slow, slow grinding halt, everybody. So this might not be a secret. By way of preview, we've kind of given you this. A year ago, we thanked you for your patience. Here we are thanking you again for your patience. This is grinding, right? And speaking of the Fed, why is it that Ben Bernanke focuses exclusively on the Great Depression, as if that were the only reliable case study to compare our current situation to? There have been several deleveraging episodes in the past where debt levels got to be unmanageable. My favorite is the 1920 to 21 period. GDP collapsed 23.9%. Prices fell 40%, wholesale prices. And in 18 months, it ended. Warren Harding did nothing. The Fed actually raised the discount rate to penalize the banks who had been imprudent. And compared to 1932, there's a big difference that I already mentioned. It ended. And it ended quickly. I said that we're hypocritical in a way at Hydel Beale, and I want to recognize that. We're, of course, our favorite hypocrites. But we have some measure of that in all of us, right? Why is this taking so long? Why is this grinding? Alternatively, a question might be, can we and are we edified for, are we fortified for a 40% drop in the wholesale price level? Can we handle that? Can we handle a 23% drop in GDP and the reset of that magnitude? Probably not, right? We're all scared of how bad it might get if we look at relevant historical statistics. But the facts are the facts. Does anyone know where the real wage level is today? Real wages are at what level? 1998. 1998. So Karl Marx was right. Capital fights with labor, labor fights with capital, sometimes labor's in the ascendant. capital can be in the ascendant. It's interesting, though. It's not as violent and direct a conflict as he might have envisioned, but it happens. In this case, though, again, we could be victims of our own success because the 1%, those who are charged with managing capital, investing it, have enjoyed a much higher standard of living and growth in income that belies the common wage earner. There's more to it than that, though. Labor and capital are two sides of the same coin. The way we revere capital, the way we celebrate it, the way some people are even willing to die, I'd say the capital's got us often rather than us having the capital. So where are the green shoots, everybody? How are we doing? Households are great. They really are repairing their balance sheets. Time, like it always has, will heal this, and we'll get through it. But God, it is taking a long time. I didn't think a year ago when I was thanking you all for your patience and hanging in there as we bought more treasuries, that we'd be here still a year later, putting on the same trade and even deepening it in some cases. But here we are. And it underscores how I think we'll get out of this. Can you imagine Greece getting their 65 billion euros they need by August? Can you imagine China having anything other than a hard landing? That might be a complex question. But I say, I'll answer for you, no. You know, our Fed's financial tools are pretty crude. I mean, interest rate manipulation, money printing in order to enforce an interest rate or peg an interest rate. But China's tools are even cruder. So, yeah, I just think we are not getting out of this without at least one more big deflationary scare. But don't worry, everybody, you're okay. I mean it. As a thoughtful, maybe you'll say I'm optimistic, intelligent, contrary-minded firm, we've really tried to build in investments which we think will survive and, in some cases, even thrive in this environment. The news is likely to get darker in some ways. But I hope that doesn't worry you about your investments. The darker news could be falling prices. A lot of producers aren't ready for it, and there's still some leverage in the system. If you've borrowed money to buy inventory and now that inventory is worth 20% or 30% less, well, Harry Truman knows about that. He was caught in the 40% wholesale price decline of 1920 and 21 and lost his haberdashery in St. Louis. Maybe why he egged on the Fed post-1946. China is an essential part of the growth story that we've seen since the decline. But the signs are very strong that China is going into remission. It's most evident to everyone in the commodities market. So year to date, copper prices are down, iron ore is down, Australian dollars down. Australia can be thought of as a colony of China, furnishing them with all their commodities. The CEO of BHP Billiton, one of the largest commodity and mining companies, announced recently that they have an 8% volume decline to China when everyone was expecting it to be flat. And he said flat would be an uptick. But this is not reversing. It's estimated that China has over 100 million vacant residential housing units. Yeah, we have about 2.5 million. to maybe 3.1 in shadow inventory. Ours is about 5 years worth of supply. China's is estimated to be about 19 to 22 years of supply. What happens in a world like this? What happens when central banks have been so good at expanding credit? Really, we're victims of our own success. The Fed says they don't want deflation. Well, it's too late. If you didn't want the deflation, you shouldn't have had the inflation. They inter-are. They come together. There is no cure for the iron law of economics, and the price level, whether it's for assets, commodities, and or everything else, will have to adjust. Maybe wages will come up to 2008 levels, but I doubt that'll happen very quickly. So this is a gradual process, but it doesn't have to be. But we all have a stake in this. We're all somewhat hypocritical. I mean, Greece should have exited the euro 3 years ago. Why do you think they didn't? Today, I heard a Greek gentleman saying that, well, we want to stay in the euro more than we want austerity. Well, you can't have both. So now the conflict is shaping up. And I honestly think if we do think this through, it really is unavoidable for us to have another deflationary moment. Will it be a huge spike? Will it be a long Lehman-like episode? I really don't know. I don't know. But I'll tell you, the central banks of the world have a lot less firepower now. The governments of the world have a lot less firepower now. In some places, the citizens of the world have a lot more firepower and leverage. So it's shaping up to be an epic battle. How will it resolve itself? I don't know exactly, but I don't think you're going to survive it by being long commodities, buying copper and corn, emerging market stocks. Our stock market itself, if the atom of financial matter, the unit of account, the currency itself comes under question, what are things worth? How does it resolve itself? Being long the highest quality assets, treasuries, in some ways the least dirty shirt in the hamper. We've all heard this joke now for a year, 2 years. Being long gold as an alternative to currencies are in many ways and have proven themselves to be historically bulletproof. Is anything a perfect hedge? No. But I do see interest rates dropping further, everyone, as part of this deflationary cycle really coming to grips. Historically, bond prices have traded at 2% real, long-term bonds, treasuries. 2% in a very tight band over the rate of inflation. So whether the treasuries were yielding 13% or whether they were yielding 10%, you're getting about a 2% real rate of return over inflation. This data goes back to 1857 and is courtesy of Jim Bianco at Bianco Research. The missing data is for the Civil War in the early 1870s. It's not reliable. But it's a pretty long measurement. If that's the case, then we could expect easily a 2% print on treasuries. Look, the 10-year German Bund today came in at 1.28. We're in better shape than Germany. If the German 10-year bond can come in at 1.28, let's call it 1.3, then so can our 10-year. And back to the historical record, interest rates have historically bottomed when the spread between the 10-year rate and the 30-year rate is only about 0.5%. Again, it implies that we could even see a sub 2% print on treasuries. What does all that mean? If interest rates fall, the value of your bonds goes up. The long bonds interest rate fell from about 4.3 to 4.4% at the beginning of last year and finished under 3%. It backed up a little early this year, and now it's on its way down again. The bond market's enjoyed 9 consecutive weeks so far, and counting, of a positive return. It's the best since 1982. Why now? And why did it soften in the beginning of the year? Another attempt at stimulus. A year ago, we had the same story. It was quantitative easing version 2. So, what's to stop them from quantitative easing 3? They've shown they'll do it. It's a fait accompli, everyone. More stimulus is coming because we can't live without it. We're addicted. But the truth is, as I said in last month's brief newsletter, there is a diminishing marginal return. Though, to be fair, I probably should have even gone back further. Because in last month's letter I said the quantitative easing gave us a 97% stock market rally and lasted almost a year. The second author of quantitative easing, since most of this monetary inflation is finding its way into the stock market, gave us a 17% rally. Now, and lasted 6 months, we've got a 29% rally that's lasted about 5 months. Each time, and this third effort is really come from Europe, the long-term refinancing option, because Operation Twist seems to have had very little effect. So central bank balance sheets have expanded now to over $15 trillion globally. So the central banks have tripled their balance sheet really since late 2006. We've got stock prices back where they were around 1998 in some cases, depends on what you're looking at. Yes, the Dow hit a new high, but it hasn't been confirmed by the transportation averages. There's a lot of non-confirmation with the NASDAQ and other indices as well. It looks really like an extension rally from the stimulus. And of course, I should have these meetings all the time because every time we have them, it seems our performance improves. It might just be timing, right? But last year, we started the year with some concerns too. QE2 was on, the bonds were selling off a bit, gold was wet, down, slow. Big parts of our portfolio weren't performing. We asked your patience and your indulgence. And it worked. Well, we still have some more plot twists and turns to go before we get to the end and before this is resolved. But we will get there. And as Benjamin Graham said, generally sound investment principles have always produced generally sound investment results. We have to behave as if they will continue to do so. And they always have. Thank you for joining us for this video presentation and for your interest in Heindel Beale & Associates. We hope you'll feel free to contact us.